I'm now joined by frequent visitor here on the show, Steve Misener. Steve, glad to have you back. Always got a lot of interesting things to say. Never a dull moment in Wall Street and Bay Street. Larry Kudlow made an interesting comment.
He did. He's President Trump's advisor, but long-time Wall Street personality, and for years a very, very high-profile guy. And he recently said that for the rest of his lifetime, he doesn't see interest rates going back up again. That's a powerful statement. And it's kind of interesting because it echoes former Fed Chairman Ben Bernanke, who in 2014 said essentially the same thing, that he did not see rates climbing for the rest of his days. Now, we've had a little backup in rates, but I guess they're talking about major long-term secular rising rates like we had decades ago, and perhaps they're right.
Maybe we won't see that. And I know, you know, they were pretty rambunctious back in October, and it looked like they were pricing in this rate, and then now I read that the next move might be down.
Yeah, it's amazing because the Fed and all central banks around the world, they only have two, I used to say, arrows in their quiver. They can tell people they're going to raise rates, which is the soft arrow, and then they can actually use the big hammer and actually raise rates. And they're equally powerful because just indicating trend, indicating an intention to tighten is what caused the. It wasn't the December hike that was well anticipated that caused the stock market to get really corrected in December and to create that scare as it did. But it was the speaking that even then we're still planning 3 more rate hikes for the 2019 year,
right?
And then 90 days later, they're not hiking rates, and they're telling people maybe we should, they won't admit we made a mistake, but they're saying maybe we should dial it back a bit and keep an eye on the numbers. They always say we're keeping an eye on the numbers. A good economist forecasts often.
In Asia, we've got a new number 2 market in terms of size.
Yeah, recently, just the other day, Hong Kong's market cap at just around 5.7 trillion US dollars, and that's adding up all the market caps of all the listed stocks on the Hong Kong Stock Exchange at 5.7 trillion US, just surpassed Japan to take the second spot as the largest or second largest Asian market. Shanghai is the largest, but Japan was just surpassed. Now, this is the second time this happened. Back in 2015, for only 2 months, Hong Kong surpassed Japan. But it is a statement and a testament to the incredible growth of what we've been seeing economically and also capital markets-wise in China. That now you've got Shanghai and Hong Kong as number 1 and 2, and it's also a commentary on Japan's relatively subdued growth and their stock market performance for a long, long time. And famously, the Nikkei peaked out at just under 40,000, 39,000 and change in December of 1989. That's almost 30 years ago. It is this year, 30 years ago. And the Nikkei index has not recovered even 50% on a sustainable basis of that level from 30 years ago. That's what slow economic growth, domestic, and also Japan was always a big export market, and it's been supplanted by the new countries like South Korea and China taking away and cutting into Japan's spectacular historic export growth in the past.
Yeah,
that's what stagflation looks like.
But their debt's all contained, isn't it? Like, it's all within their own nation, I guess.
Yeah, they're the highest percentage of savers on the planet. The average household in Japan has something like 150 to 200,000 US dollars in just liquid savings per household or per capita. It's an amazingly huge number. And no other country on the planet has that kind of liquidity or conservative savings. So.
Yeah, this negative interest rate thing has got huge implications for banks, doesn't it? Like banks and We were talking about insurance companies, institutions. I don't understand it.
Rising rates can hurt banks in the early stages because they're deemed to be yield plays as people buy those equities for dividend yield, and obviously a rising rate structure means that we need to look for competitive yield. On the other hand, in their operating business, it's that spread between what we're taking in as deposits and our funding side, which is often bank deposits and GICs or CDs,
yes,
and other forms of funding, and then what we can lend it out to at a sort of safe spread. And in a compressed interest rate environment, margins for banks get squeezed for sure. And a rising rate environment, after the market adjusts to rising rates from a stock perspective, it's actually better for banks operationally that they have a better rate spread. I've
noticed the price of oil is sort of moving up, which, you know, that's sort of a contra signal in my mind. But oil, you know, oil prices are about the highest they've been now in several months, I believe. Mm-hmm. Like, you know.
Yeah, I mean, oil's been stuck in this sort of $45 to $65 band for a while, but it's well up from the lows of 29, but it's way down from 10 years ago at 149. Oil is always hard to forecast as the U.S. has become the largest oil producer again. I mean, that's been an amazing story as they've developed a new technology and opened up new reserves. On the other hand, it is a consumable product, so a little different than gold and other types of maybe commodities,
right.
Well, specifically gold. But as a consumable asset or consumable commodity, they always have to find more. It's a treadmill to find more. So, you know, it's fair to argue that longer term that oil prices should start a slow climb back upwards again, but in the interim, it's locked in this band. Now, it was an incredibly long, cold winter in North America, and
look at the weather today.
Well, and there's a big, giant storm out west. I was reading about in Minnesota and Dakotas. They're getting 30 inches of snow in Dakota, like just a staggering, late spring or
right.
Early spring storm, and so the heating season's going on a little longer than typical.
Right.
And then we get usually some seasonal weakness in May, June until we get the driving season going for the summer.
Steve, the cannabis space is always front and center, and we've got some major market caps. So even though the last few days have been a little touch and go, we've seen some, Tilray's been knocked back a bit, quite a bit. Any thoughts? Any clarity?
Well, I was looking at some bigger pictures, figures, and I thought one that's worth noting is that, and we spoke about this a few weeks back, that the rate of growth in the Canadian, particularly in the Canadian cannabis market, but I think it's typical across the United States and other Western world markets, is that cannabis growth right through the product line continues unabated, and it's going to be significant. But where you get, I guess, the uniqueness of this business is that you've got secular or new kind of growth of new participants, people who maybe weren't consumers before, who are coming into the retail marketplace. So that's a growth component that's substantial, and investors are watching that, and it's a substantial growth element. But the other thing I wanted to add is you've also got, in many of these mature markets, the black market or the gray market, where much of the cannabis had not been above board in terms of consumption and in terms of being on the books. And so what I was trying to get at was that there's a double growth component, I think, to many of these companies on the revenue side, is that we've got the secular growth in cannabis consumption and new markets amongst the Western world markets, and in fact all over the world that's legalizing. But then you've got this extra revenue stream where gray market sales and black market sales become onto the balance sheets or sort of income statements, and therefore generating extra revenue for the companies, extra jobs, extra taxes for those regimes. So really the growth rates could be continue quite substantial for a while, notwithstanding as the market sorts out where the valuation should be in the short term.
Steve, thanks for coming by. Really appreciate your contribution. We'll have you back soon.
Absolutely, my pleasure, Eddie.